Guys, today I'm going to be giving you my favorite long-term screener using TradingView's free screener tool. The first thing we're going to do is navigate over to the TradingView screener by going to TradingView's site, clicking on Products, Screener, and then Stocks. We'll be left with the free screener that TradingView offers. Once we do that, we're going to add 5 things to this screener to find good long-term investments as a starting point for stocks to look for. The first thing we're going to do is we're going to use the PE ratio. For the PE ratio, we're going to do 25 and below. You see this is modestly valued there. The PE ratio tells us basically how much investors are paying for each dollar of the company's earnings. So under 25 usually means you're not overpaying, especially if the company has stable growth. The thing you will notice is that a lot of financial companies, we can already see here, Berkshire, JP Morgan, insurance companies, banks, a lot of them naturally have PE ratios less than 25. So that's something that you'll need to take into account. It varies from industry to industry, and naturally, finance has lower PE ratios. The next thing that we're going to add is the EPS diluted growth. So this one you're probably going to have to look up yourself. So you're going to hit the plus and type filter name in. Under there, you're going to hit earnings per share diluted growth percentage, and you're going to click annual year over year. It'll give you an option for what you want, and you'll click annual year over year. Okay, so once you have that, you're going to go to manual setup. Annual year over year, above value, 10%. And we're going to apply. Basically, a positive 1 year EPS growth shows a company has good momentum, and it shows that the company is actually growing profits in their short term. You want consistent growth, so this is a good screener to add for long-term investments. The next thing we're going to use is the debt to equity ratio. You can see right here. So you're gonna have to do the same thing here. You're gonna hit add new filter, and you're gonna simply look up debt to equity right here. Let's see. So they have the quarterly, so you're just gonna be using the quarterly, and you're gonna hit 1 and below. There's that. So basically this shows how much debt a company uses to fund itself compared to shareholder money. So a company under 1 means it has more equity than debt, which generally means there's less financial risk associated with the company. So in a down run of the company or the stock market in general, a business with too much debt might struggle to stay afloat during a time like that if they have a high debt to equity ratio. But a company with a debt to equity ratio below 1 will usually be able to survive this because just naturally of what it uses to fund itself. And the last thing we're going to add here is just analyst rating. And this may seem, some people might disagree with this, but generally analysts in general, they usually have good inputs on stocks, and they usually have access to research and industry insights and forecasts of companies that we might not have. So it's just a good way to confirm your assessment on the screening and make sure that we're looking at the same things here, and that there's a consensus agreement between analysts and yourself. And once we do that, we'll be left with a few good companies here, 262 to be exact for this screener. And this is where we go more in depth. You can screen to narrow down your companies, but in order to find the investments that you actually want to look for, you're going to need to go into each of these companies, find out what these companies do, find out if they're profitable, find out why their PE ratio is so low, what have they done in the past, why is their stock price undervalued, And is it for valid reasons, or is it for something that you think they can overcome and eventually recover from? So, for example, Google here, if we just look up Google stock, right? Since this recent pullback, Google hasn't fully recovered. If we look through, we see other tech stocks have all recovered, right? Let's see, Apple. Apple hasn't quite. I know Microsoft has. Other tech stocks and the SPY in general have recovered from this recent pullback. And Google still quite hasn't. And on top of that, Google's price to earnings ratio is much lower than other tech stocks. Now, what is the reason for this? It could be things like Google Chrome, the lawsuit going on with Google Chrome being potentially split up, the news with the Tesla, whatever it's called, the taxi crushing Waymo, and the sentiment around that. Could be a multiple different things. But the good thing to notice about Google is while ChatGPT is the main face of AI, Google is actually leading in AI currently. So Google's could be a great long-term investment just because of their advantages in AI, the amount of money they have to spend on AI, and the resources they have to get ahead of the game and things like that. And other companies like these, let's just look up Uber, for example, right? We take a look at their financials here. I think they'll come up. Well, I guess not. But you can do your own research on these companies and just kind of look at their financials, look at the long-term outlook for the companies. And like I said, this screener is a long-term screener. So you're going to want to use it to look for companies to invest years for years that you're going to be holding for a very long time. And this is just kind of how I narrow down my list for companies to look for with these attributes. I hope you guys enjoyed the screener, and hopefully you can use it to find your own companies. That's all. If you enjoy, please follow.